I have received many questions about investment strategies for the rest of 2022. It's no secret that the values of many equities, as well as bonds, have fallen significantly since the beginning of the year. Investors want to know if they should be selling some of their equity and bond holdings, or should they be investing more because there is a high probability that equity prices and bond prices will start increasing in value in the near future? It is not likely that inflation will quickly return to much lower levels in the near future. Also, it is not likely that the war in Ukraine will end quickly, resulting in lower energy costs. Even though equity prices have fallen, many experts believe that the value of equities is still too high and can fall further. The bottom line is that no one can predict with certainty when equity and bond values will start recovering in value and whether it makes sense to start buying more equities and bond investments now. It is likely that the Federal Reserve will continue to increase short-term interest rates in 2022 in order to keep inflation under control. In the short run, as interest rates increase, the value of long-term bonds will continue to decrease. So, if you want to protect the value of your current holding of bond mutual funds and exchange-traded funds, you could switch your bond holdings to shorter maturities and hold off new investments in bond holdings with long maturities. In my own portfolio, I have switched from long-term holdings to shorter maturities. In the long run, higher interest rates will provide more income for bond holdings with long maturities, but in the short run, increases in interest rates will decrease the value of bond investments with long maturities. People are also reading. Even experts cannot predict when equity prices will stop falling. In the long run, equity prices have, on average, increased more than the inflation rate. For investors who have assets or income sources to invest on a long-term basis, investment in equities makes sense. However, it is prudent to use dollar cost averaging, investing a fixed amount each month rather than investing a large amount at one time. Equity prices may not have reached the bottom. Many experts expect that these values will continue to fall in the short run. Personally, I continue to use dollar cost averaging into mutual funds/ETFs. I believe they will increase in value in the long run. Even if the equities fall in value in the short run, I will be investing at lower prices. Some investments benefit from inflation, because their interest rates are adjusted based on inflation. For months I have written about Series I bonds, issued by the US Treasury. The return on these bonds changes each 6 months. These bonds earn two types of interest. First, there's a fixed rate of interest for the life of the bond. But there is also a rate of interest that changes every 6 months based on the non-seasonally adjusted consumer price index for all urban consumers. The advantage of investing in these bonds is that you can never lose the principal amount you invest, regardless of what happens to the consumer price index or interest rates. Compare this with investments in long-term bond funds/ETFs. The value of these investments has fallen dramatically because interest rates increased. As I have said previously, you can only invest $10,000 per year in I bonds, $20,000 for a joint return. But it is a long-term investment. You have to invest for at least a year, and if you sell before 5 years, you lose 3 months' interest. See the US Treasury website, treasurydirect.gov, for more information. Markets brace for sharpest rise in US interest rates in almost 30 years. The world's financial markets are bracing themselves for the sharpest rise in US interest rates in almost 30 years, as America's central bank takes action to halt rising inflation. After days of frenzied investor speculation and signs of growing central bank anxiety, the Federal Reserve is expected to increase the official cost of borrowing by 0.75 percentage points for the first time since 1994. The Fed meeting, with an interest rate announcement due at 7 p.m. UK time on Wednesday, will be preceded by an emergency meeting of the European Central Bank, ECB, to discuss crashing bond prices in Italy, Spain, Portugal, and Greece. The Bank of England is expected to raise UK interest on Thursday, after the rise in UK inflation to a 40-year high. Despite some speculation of a 0.5-point increase, the city expects a 0.25-point rise to 1.25%. The Fed's chairman, Jerome Powell, had previously ruled out a 0.75-point increase, but the central bank appears to have had a change of heart after higher than expected US inflation was announced last week. News that the US measure of the cost of living had hit 8.6%, the highest in 4 decades, prompted a sharp sell-off in both bonds and share prices, as investors took fright at the possibility of action to combat high inflation leading to recession. The S&P 500 index, a broad measure of the health of the US stock market, has fallen 20% since its peak in January, while the technology-rich Nasdaq index has dropped by a third. Investors have now fully aligned with the view that the Fed will hike by 0.75 points today, following the unexpected acceleration in inflation and inflation expectations in May and media reports suggesting the option was being discussed by policymakers, said analysts at ING Bank. While a 75 basis point move is not certain, we doubt such potential leaks to the media are a coincidence, and they do appear to us as a successful attempt to adjust expectations during the blackout period and prepare markets for the larger increase. The prospect of a bigger than expected jump in U.S. interest rates coupled with weak growth figures in the UK pushed the pound to its lowest level in 2 years against the US dollar. Sign up to the Daily Business Today email or follow Guardian Business on Twitter at Business Desk. Neil Wilson, an analyst at Markets.com, said of the ECB move, "Given there was a scheduled meeting last week, it smacks of panic and a lack of control, but the market is happy to see it happen." European bank shares rose and the euro also rallied, while Italian yields came back down. Andrew Kenningham, the chief Europe economist at Capital Economics, said, "News that the ECB Governing Council is holding an emergency meeting today shows that policymakers are taking the threat of rising peripheral yields more seriously than they were last Thursday at their regular policy meeting." The Fed statement and remarks by Powell at a press conference immediately afterwards will be scrutinized to see whether further sharp increases in U.S. rates are likely. Some analysts think the central bank will raise them by 0.75 points again next month. Make sure to like and subscribe to MarketLux for more great content.